Joining us to talk about it, Bob Ivry. He wrote the story and broke it for Bloomberg News. Also via telephone, contributing editor and Bloomberg View columnist Bill Cohan. He's the author of Money and Power: How Goldman Sachs Came to Rule the World. Well, maybe that was a little quick. Maybe they haven't ruled it quite yet. Bob, tell me about breaking this story and getting the information out. Why did it take so long for us to discover this?
Well, the funny thing is, Pimm, I wrote a story in May when I discovered this program. They didn't publicize it much. It was the expansion of an existing program that was used for money controlling the money flow in the financial system. It was expanded during the crisis to help get money into the mortgage-backed securities market. And the way the Fed did that was it lent money to the primary dealers. There were 20 primary dealers at the time. And Goldman Sachs took the biggest one-time loan from that program. It was called single tranche open market operations. And I know the name makes eyes glaze over.
That's all right. But the $15 billion number, that certainly gets your attention.
Yes. And Credit Suisse was actually the one that had the most loans outstanding at a time, $45 billion. And Goldman was number 2. So Goldman had the biggest amount of loans outstanding. What they did with this money was either they used it to finance their own portfolio of mortgage-backed securities, or they helped their customers, such as hedge funds, finance their portfolios of mortgage-backed securities. And that was a market that wasn't doing well at the time. And we're talking about 2008, so that market wasn't doing well at the time. That's
an understatement, right? It wasn't doing well. Bill Cohan, what about $15 billion alone? Did Goldman Sachs need it? Because at the time, certainly, they gave the impression that they didn't need the loan. They were just going along for the ride with everybody else.
Well, Pimm, I think you have to remember here that this was relatively cheap, long-term money that the Fed wanted primary dealers like Goldman Sachs to have. And so from Goldman's perspective, if they're going to give them this much cheap money for 28 days as opposed to overnight, why not take it? And why not take it in bucketfuls? So, Goldman's pretty smart. I'm sure they said, look, this is a great way to help finance our business. As you pointed out, finance our customers, finance our own balance sheet. They had to put up collateral, pretty good collateral to get this money, number one. And some of the other major primary dealers at the time, like Citibank and Morgan Stanley, were not in this market because they were busy trying to, keep themselves from going down the drain. And that left Goldman and I guess Credit Suisse in a position to scoop up a lot of this. So from one perspective, it does make a lot of sense that they would go after this money. I mean, why it's taken so long for the information to come out, which should be, fairly, there's no reason it shouldn't be known more widely and easily. I mean, why it took Bob doing such a great job to get it out there is a bit of a mystery, but it's not that big of a mystery about why Goldman would want this money.
Bob Ivry, there's a difference between getting money because it's cheaply available and being able to put it to use, and taking it because you need it for your survival.
Right.
I mean, do we need to make that distinction here?
I don't, they won't tell me what they did with the money. I asked them, and I asked the other banks too. I said, well, what did you do with the money? Well, they financed their mortgage-backed security portfolio, or perhaps they, some of them have told me on the QT, well, we had customers that wanted to finance their mortgage-backed securities portfolio. So did that, in turn, allow the lenders to make more mortgages to folks
to profit from this?
I don't know. I don't know. And the mortgage industry was fairly frozen at the time. So if that was the case, if that was the goal, perhaps it didn't exactly work out. But I just want to reiterate what Bill said. I mean, the last loan that Goldman took from this facility was for 0.01%. And if you are given the option to borrow billions of dollars for 0.01%, you've got to be an idiot not to say yes.
So you say yes and you ask for more, Bill Cohan.
Right. Well, and Goldman is anything but stupid. So they saw money being given away by the Fed, who obviously had a mission to pump liquidity back into the system, uses the primary dealers to do that. This was an auction system. Goldman bid an interest rate for this money and got it in part in such size, in part because, as I said, Citi and Morgan Stanley weren't in the auction. So I think, I don't think it was a question of Goldman's survival at stake. I mean, by this time they were already, a bank holding company. That had happened in September. They had already gotten the money from Buffett. They had already gotten another $5.75 billion from the public investors. They had already gotten the TARP money. So I don't think this is about survival at this point. We could have a separate debate about whether, they would have survived in September had they not done all that they did in September and October. But I think by this time in 2008, they were just taking money because it was cheap and they were getting plenty of it.
All right, we're going to leave it there. I want to thank you, gentlemen, very much. Bill Cohan, Bloomberg contributing editor, also available on Bloomberg View, and also Bob Ivry breaking the story about Goldman's $15 billion loan from the Federal Reserve. Good work. Thank you very much.